Hello, everyone, and welcome back to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Tuesday, March 22nd. I'm Mike Bernick, and joining me today are Kathy Lean, Mike Larson, and David Dukevich. Well, stocks certainly have been on kind of a bungee jump ride here over the last couple of months, with the S&P closing yesterday at 2051.60. That's up 13% from the February lows, just on the 11th, just over a month ago. And basically right back to where we started in November 2014. We've been up and down all over the place ever since, but we're not making much upward progress with stocks. Today the S&P futures are down a little bit because of the bombings in Brussels, reminding us all that there's a lot of geopolitical uncertainty in the world today. Not really a safe place. So, Kathy, why don't we go ahead and start with you? What do you think this turmoil here in Europe is going to do for the currency markets?
Well, I think that the general public and investors included have clearly been unnerved by the devastating attacks in Brussels this morning. And I think it's important to remember that whenever events such as this occurs, the market or investors always sell first and ask questions later, which explains the weakness that we're seeing in currencies as well as equities today. Unfortunately, it was never a question of if, but just a matter of when another brutality would occur after we had those attacks in Paris back in November. Investors got complacent. So we saw that in the fabulous rally that we had in U.S. stocks, as well as a strong recovery in currencies. It has only been 4 months, and I think that the market pretty much had amnesia in regards to one of the greatest risks that Europe faces this year. And today serves as a very harsh reminder of what we've been talking about, pretty much for the past few months, which is that Europe is under attack. ISIS is targeting Europe, and today is evidence of that. So what does this mean for currencies going forward? Well, first and foremost, you are seeing European currencies hit the hardest. Euro as well as British pound are down sharply this morning. Now, back in November, when we had the Paris attacks, we initially saw a 3-day decline in the euro, with the euro falling from about, I think it was 108 down to 105 after we had the entirety of the move. Now, the initial decline was only 3 days, and there's a bit of a pullback before everyone realized that this is probably going to cause the ECB to potentially do more easing, and they drove the euro to multi-year lows. We are in a slightly, but I think just as urgent situation right now. First and foremost, the euro is trading a lot higher than it was back in November. So that means there's a lot more room to fall. The only caveat here is that the ECB has just launched a aggressive easing campaign. So they're not necessarily going to be jumping the gun to do more. So there's a difference between November as well as now. So I think one thing that I find quite encouraging is that the market and investors tend to be fairly, and the general public in general tend to be fairly resilient to these terror events. They don't let the terrorists terror them. And so while we may see a further decline in the euro, we're not looking for this to cause fresh multi-year lows in the euro like it did back in November. So we do believe that this is going to pull the euro back, most likely to that former resistance support level right around 110, and then it could stabilize there, because I don't think that this is enough for the ECB to unleash another program. If we get a few more coordinated tests, I certainly hope we don't. That would be a different story. But I think this is panic selling that will last for a little while longer. In the grand scheme of things, we still think Europe is in big trouble, but you're not going to see necessarily the multi-year lows that you saw back in November. What you will see, however, is a continued demand for gold. I think that all of this tells us that we need to look for safety, and commodities are a nice source of safety. We've seen some decent, even though we've seen a lot of the major currencies hit hard by what we call risk aversion. The Australian dollar is doing very well this morning, and I think a large reason for that is because investors are basically looking to gold estate for safety, and the Aussie is a beneficiary of that. So overall, this is a big story. It's one that's going to, unfortunately, I hope not come back, throughout the course of the year. And I think this is just the beginning.
Okay, thanks, Kathy. I appreciate those comments. Mike Larson, let's get your views.
Yeah, thank you. Obviously, again, it's hard to watch and hear about these kinds of events in Europe. It's not like we're very far removed from what happened in Paris, and the issue with European mobility and all the immigration that we've seen recently in refugee crisis and so on. There's just so much instability over there, and it's obviously hitting home in some of the core financial and political capitals of Europe, and that's a tough pill to swallow, a tough thing to wake up to. I think just in terms of the market environment, it's probably one of the most manic, depressive type environments I've seen in a long, long time. What was it? Just back in January, the world was falling apart, and then in the month of March, the world is perfect again. If you just sort of looked at just a stock chart and said, what's going on out there, that's what you would conclude. You would conclude all hell was breaking loose a few weeks ago, and now everything's peachy. I don't really think that that's the case, but that type of very sharp decline and very sharp rally, it's very similar to what we saw in August and then September and October. The markets had a huge decline. It had what looked like a double bottom, then a big rally off that level. Then ultimately it failed because the underlying economics, the underlying credit market conditions, and credit point in the credit cycle just don't argue for a new leg up in this bull market. I think central banks and the ECB in particular keep trying to intervene into a market that unfortunately this intervention is not well timed. You can't really you can't really try and expect to have success unleashing a whole new easing cycle in up move in stocks and up move in junk bonds and corporate bonds and so on, which is kind of what the ECB wants to happen when you're already basically 7 years into an extraordinarily easy credit cycle and environment. It's just not the right time for it. One of the reasons the extraordinary interventions worked in 2009 in 2008 is that they came at the tail end of the down leg of the cycle. Things had already gone to hell. The market had already blown up. The real estate market was already crashing. So when you had all that intervention, it was after all the bad things had already happened and a lot of the garbage was cleared out. So that's why that stuff worked. Now some central banks like the BOJ and ECB are trying to unleash all this massive easing and in the case of ECB, buying corporate bonds to reignite risky behavior when the risky, the crash never is or hasn't really happened yet, which is why, you try and unleash those measures when you're still just popping out in a credit cycle and it doesn't really work. Whereas if you do it at the tail end, when all the bad stuff has already happened, that's when you can have success. So long story short, I'm not really buying into this bounce. I think that the possibility and the probability of failure after this big rally is pretty high because, again, the underlying fundamentals for a new leg up in credit risk and risky markets and so on just aren't there as far as I'm concerned. So, again, I think this is a pretty important level for S&Ps and Russell and Dow and so on, but I think the likelihood of failure is higher than the likelihood of a run up to new highs. That being said, the sectors that I remain invested in and that I have been talking about a lot in safe money and money markets and so on have been leading this charge. I mean, this hasn't been a market rally led by, high risk sectors like tech and financials and so on. I mean, if you just put a chart of the XLF up on your screen or the QQQs, I mean, they're nowhere near their highs. Their highs from earlier in 2014. Whereas you look at something like the Dow Jones Utility Index, and it's off the charts high. If you look at something like the XLP, which is the consumer staples, it's made a new high. So this is a market rally being led by high yield, low volatility, low risk, non-economically sensitive sectors, which tells you where you are in the cycle. That's the kind of stuff that tends to perform at this stage when growth is weak and recession is a concern and so on, and people don't want extra risk. So, the stuff that I kind of expected to go up is going up, and other parts of the market that typically perform well early in an economic cycle are lagging badly. So I think that kind of confirms my overall view of where we are. So we'll see. Again, we're heading into some important levels here, and I think that the risk of failure is pretty high at this point.
All right, thanks, Mike. Yeah, that's very true. Good point that the higher quality, more defensive sectors have led this rally, which tells you a little something about the investor sentiment out there. David Dukevich, let's go to you. Give us your take, especially on gold. A couple of people on the call mentioned that.
Yeah. Hey, Mike. Hi, everyone. Gold has caught a bid here, obviously, with what happened in Europe. It's still trading right around the 1250, 1255 level. And with that, we do need to get back above that high of 1287, 1288. If we get through there, I think we will push to the 1300 level. We'll see if we can break through there. But right now, even with this, it's catching a bid. But I do still think we still need to see a bit of a pullback in gold before we move higher again. So we'll see. I mean, it's trading right in that range, about 1255. I do think a pullback to around 1200, 1188 is still in the cards possibly. But we'll have to wait and see because right now it is catching a bid. The gold mining stocks as well keep moving higher. Silver is kind of at a critical level as well, right around the $16 level. It's just below that. If it can get through there, that could make a run higher as well. If it can, it kind of gets stopped out here at this resistant level. That silver could pull back a bit as well. Oil itself, is trading just above $40 right now. We might see a bit of a pullback here, maybe to that 37, 38 level. If that holds, that would be great because then we could get that push higher to where we get maybe into the upper 40s, closer to the $50 level. When speaking of equities, volatility before this happened, it was extremely low. The VIX had one of its sharpest 25-day declines and record. Back on February 11th, it was closed above 28. Yesterday, it closed below 14. So that's a pretty extreme move in a short period of time, which would make me suggest that that's been a little overextended. So I would expect to see volatility increase here at this point. So I would agree now's the time to probably start to reduce your net long exposure and possibly even add exposure to volatility at this point.
Yeah, the S&P 500, David, has been up for 5 straight weeks now after seemingly going down pretty much every day during the month of January and early February. We've done just the exact opposite. But now the S&P 500 index is more than 2 standard deviations above its 50-day moving average, which basically means we're extremely overbought. Do you expect maybe a correction to bring us all the way back to the recent lows from February, or could it be not as much of a pullback as that?
Well, I don't know if we'll see a pullback all the way back to those lows, which is getting closer to the 1800 level. Mm-hmm. Right now, we're trading, like you said, around that 2050 level. We potentially could extend a little bit higher, maybe to 2085, somewhere in that range. But I would expect a pullback. Obviously, the main first level of support is going to probably be around 2000, maybe 2020 in that range. But I think the main level that we really got to watch is back where the 1950 level, which was really the breakout point we had for this move higher. If it can hold there, that may mean that's all we're going to get on a pullback. But if we break that, then we're looking that we could start to really push back down again and possibly test those lows again. But we'll have to see. Right now it's hard to say if we'll get that big of an extreme. But like you said, when the markets are on this, more than 2 standard deviations outside of its normal range, a pullback usually does come to at least back into a median range. So we'll have to wait and see how extreme the selling gets.
Yeah, it certainly has been a buying binge in recent weeks. Thanks, David. Appreciate it. Well, that wraps things up for this week's Squawk Call. Great insights, gentlemen. Thank you, one and all, and ladies. And be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.